produce this report. I'm so proud of what Clarmondial has done, and I hope and I know that they are as well. It's a remarkable achievement. Maybe to say a little bit about where this came from, the Clarmondial had written a couple of reports over the last few years, conservation finance report with Credit Suisse, and then a very short piece called Leveraging Ecosystems that I think I'd really recommend you go back and have a look at. As I got into the world of landscape finance, I read a lot of documents, and I must say these two documents stood out for me as the clearest statements of the problem. And for the Leveraging Ecosystems report, it set a very clear and simple taxonomy about the different types of finance and the different types of issues that needed to be addressed. So I talked to Tanya Haberman, who's the CEO of Clarmondial, about whether we could go on to the next stage, whether it might be possible to think about how to actually turn that taxonomy into action, and that's where the report was born. The idea for the report was born. We worked together on a broad structure, and really, most of the work was done by Clarmondial. But I think what we have now is a very systematic and thoughtful framework for looking at financing of conservation from the private sector, and that takes us to a very different place to where conservation has been done in the past. In the past, conservation is very much about paying for the work and getting results back, but not necessarily any more money back that can then be reinvested into conservation. I think when you look into the future, it's a completely different world where it's possible to not only invest money in conservation results, but get returns back on that can then be ploughed into creating more results, and create a spiral of positive benefits. The finance industry has been a cause of environmental destruction because it's funded many of the things that are destroying nature, but I think it can be a driver of the solution. And Kaspar and I were at the Climate Bonds Initiative conference only a couple of weeks ago in London, where we saw a remarkable change in the finance industry. There's $250 billion of green bonds that are going to be issued this year. How they're issued is absolutely fundamental. What they are investing into and finding the projects on the ground that really make the difference, that's our challenge. And I think the taxonomy and the guidance that Clarmondial and the Capitalising Conservation report gives us the next steps along the way. It's only the beginning. This is a long journey, but I think they're very, very important steps, and this is a superb guidance. So let me hand over to the guide, Kaspar Baumann, and let him explain more about the report. But Kaspar, to you and Tanya, I want to say a very warm thanks. It's really been a pleasure working with you, and I look forward to much more ahead.
Great. Well, thanks a lot, Paul, for the kind introduction. I hope you can hear me well. I can maybe give a quick overview of what we do at Clarmondial, just to put this into context. But first of all, thanks to Paul for facilitating this report, both with financial resources as well as with a lot of valuable input and contacts. I think what we try to do is really, reach out to many of the relevant players in what is still a small but growing field, so that this report is not just something, not just a brainchild of Paul's or ours, but really something that many players in the industry have contributed to. And I think this is something we were quite successful at, to really pull in a lot of views and opinions and ideas of other conservation organizations or foundations or investors in the space, which has also led to the report growing to maybe a bit larger size than we originally anticipated, but there was also a lot that we couldn't include just because it was out of the scope. So I think all of you, who have looked at the report would probably have thought of things that should have been covered but are not in there. So I guess a lot of these points we did think of at some point, but just decided they were out of the scope. And but obviously looking forward to the questions afterwards, and there might also be some other things to add in future versions of such reports. To Clarmondial itself, we're as Paul has introduced, is a small investment advisory firm based in Zurich. We have some colleagues in the US as well as in Costa Rica and Kenya. And we're really focused on mobilizing investments into the environmental space. So looking at transactions in sustainable agriculture and forestry, as well as renewable energy, basically all that's centered around sustainable natural resource use and rural development. And the role that we tend to have is often translating between the projects that require financing, or the companies that require financing, and investors. So, we help to translate basically what is a project that has maybe some social or environmental impact into a language that investors can understand, and into a format that investors can work with. And I think the Capitalizing Conservation report is very much in this line, where basically we wanted to give conservation organizations and other groups working in conservation finance basically a tool that makes it easier for them to view their work through the eyes of an investor, and to maybe provide some hints as to how an investor may look, to really make them work for investors. And there's obviously, this is not something which has a black and white answer. So what we really try to do is to look at what are the categories of investors, what are maybe the benefits or disadvantages of working with them. And when it comes to the framework that we propose in the report, it's not about coming up with a conclusive list of metrics that should be looked at, or of structures that should be used, but more kind of trying to spark the questions that developers of investment opportunities should ask themselves and their projects, so that they may become easier for investors to finance. And in terms of the content, I hope you can see me switching the slide here. I hope the slide share works. So the main components of the report are really a framework that I will discuss a bit, highlighting some important factors when structuring investment opportunities in conservation, and then also a number of case studies which we try to present in a consistent and easy to understand way. And I think what has been done in the space is really an important basis on which further investment opportunities can be developed. I think both in terms of looking at what has been done, what can possibly be replicated, but I think for anyone really working on concrete investment opportunities, it certainly makes sense to reach out to groups such as those highlighted in these case studies to learn from their experience, because I guess there's a lot that can be shared. So in this presentation, I'd like to highlight some elements of the framework. Obviously, it's a small snapshot of what's really contained in the report. But I think one of the key messages that we try to send in the report is that, structuring an investment, the structure is something that comes at the end of the process before, you know, the money gets to flow. But there's a lot of work that has to be done before. We see that, you know, people often get excited about certain structures, and you know, they want to do a green bond or a results-based payment structure or an impact bond, and then they try to kind of fit whatever they're doing into that framework. And our approach is really always to do the opposite. To see, you know, what is the project you're looking at, what are the financial and non-financial metrics that can be achieved in that project, and then to see, okay, how do you embed this into a legal structure that can really matches the financing needs of the. So one of the important aspects when selecting potential projects to finance, and here we really see that, you know, these could be either projects that are already ongoing or projects that are newly developed for the purpose of being financed, both having, you know, advantages and disadvantages, you know, being some track record in existing projects and maybe, you know, familiarity with the stakeholders. But often it's also difficult to morph an existing project into something that's investable. And of course, if a new project is started with the goal of being financed, it can from the beginning be structured in a way that might be relevant for investors. But also there is, you know, probably no track record, relationships are less tested, etc. So to give an idea of some of the metrics that could be looked at, obviously, if we're looking at conservation investments, we are in the field of, you know, impact investing, where investors will want to see both financial returns, but also non-financial returns, which have to be measured in a certain way. And in the report, we lay out a few examples of such metrics. And I think this is something which is quite fundamental to the project design, because these metrics have to make sense both for the project itself and the conservation goal it is trying to achieve, but they also need to be something that investors can identify with, and they're almost like a marketing tool of the project when you're selling it, so to speak. And I hear someone might not be on mute. There is some background noise. I'm not sure if you all are hearing that.
Yeah, I'm having the same problem, but I can't find anyone that's not on mute. I was just worried that it was coming from your side.
No, it's not.
No, okay. Yeah, so if everyone can mute themselves, please. Yeah, we're hearing some background noise here.
Perfect. Thank you, Desha. All right. No. Yeah, so this is really to illustrate some of what's shown in the report. You know, for example, if a project is looking at sustainable management of a wildlife reserve or forest, you know, there's obviously, you know, the area under management that could be a relevant metric. Or if you're looking at you know, at climate mitigation, I think that's probably one case, you know, that folks are familiar with. Obviously, the CO2 you know, equivalent that is being mitigated is a potential metric that could be looked at. The report provides, you know, a range of other examples for various types of projects, and here in the report we really focus on more the environmental type of metrics, and typically investors would look at at social metrics as well, and combine those you know, into a reporting set which covers both sides, both the environmental and social aspects. But in the report, it's really, we're focusing on the environmental metrics that may be relevant. Moving on, another aspect which is highlighted in the report are really the stakeholders of a project. And I think many of you, and at least those working for WWF or other conservation organizations, are well aware of the complexity of having diverse stakeholder groups involved. I think if one is considering a conservation investment around a conservation project or initiative, I think there are two aspects that really need to be analyzed for all of those groups, which is, of course, what can they contribute to the project. Be that, say, a corporate which is buying from a certain region or a certain forest area, or be that the farmers working in a certain landscape and the practices that they use, or be that the local population which may be able to use a forest in one or another way, or to use natural resources in one or another way. Of course, local governments are an important stakeholder in any case. And based on that, the next step is then to see, okay, if we implement the conservation activity, what does it mean for these various stakeholders? And are there, costs implied for them to, changing behavior, changing sourcing strategies, changing agricultural practices, or are there reduced revenues? So basically, this would be, if you compare it to a mainstream financing project, that's basically where, some of the cost of your project would lie. Obviously, there is operational cost to implement a project, and we can, discuss the various cost layers involved in conservation finance in more detail later. But what is, distinguishes conservation investments from normal investments is really that maybe here you have costs or reduced revenues accruing to these stakeholders that you would have to consider in the design of that investment. Moving on to the next step of the framework, the investment opportunity structuring. I think this almost looks at the other side of the coin. So there might be groups that have increased costs or reduced revenues as a result of the conservation project that is taking place. On the other hand, you would want to get out of that activity some form of revenue or some form of cost reduction or risk reduction, which would be basically the benefit that would be captured by the investment opportunity. And the revenue sources can be varied. They can be direct goods that are being sold for cash, but of course, produced sustainably. So that can be, for example, timber or commodities. And then there are other revenues which less directly come out of the landscape. So, that could be ecotourism, and then other forms of revenues where basically a value is attached to something which doesn't have an intrinsic financial value, such as carbon credits. Obviously, it depends on the jurisdiction. There might be a mechanism there to value carbon credits or not, and payment for ecosystem services as well, where basically be it a foundation or an NGO or a government or a municipality attaches a value to an ecosystem service which is not usually paid for in cash. And in addition to such revenue sources, or instead of them, you might have cost or risk reductions that follow from your project. So for a corporate, that might be increased stability of commodity supply from a certain region. You might have reduced use of agrochemicals due to better practices in agriculture that have a direct cost implication, cost savings in losses, increased catch in fisheries. So there are various ways in which an activity that you're undertaking, conservation activity that you're undertaking, which benefits the environment, but also reduces the cost of the stakeholders acting in that region. And this list is of course not conclusive, but again, it should kind of suggest a way of thinking about a project when designing it as an investment opportunity, that this process should be thought through to see really, okay, where do we have potential revenue sources, or where are we reducing costs for the stakeholders that can be captured in a way by the project. The next steps of the framework are investor engagement and delivery of the project. I think in investor engagement, what the project or what the report really highlights is that it's important for a promoter of a conservation finance opportunity to, on the one hand, of course, understand the project and the opportunity they're selling, and the stakeholders and the revenue sources, as we discussed. But it's just as important to understand how the investors think and how they operate, what their restrictions are, what their goals are. And this is often something we see, that project proponents are extremely familiar with and comfortable with the projects they work in, have long-standing experience, know exactly the stakeholders and the landscapes in which they work, but don't spend sufficient time on understanding the other side of an investment opportunity, mainly the investor, and how they operate and what drives and motivates them. So I think it's quite important to almost do like a form of due diligence as far as that's possible before meeting a potential investor face to face, but to screen the landscape of potential investors, to understand which groups have the type of capital a certain project requires, the volumes, and to also see who has capital available for which amount of time, and what does that match really with the project, to make sure that the groups which are approached as potential investors are also a reasonably good fit. Obviously, it's then always a matter of decisions to see if the investor actually wants to allocate that capital, but there's a lot of screening that can already be done to increase the efficiency of identifying a suitable investor there. And the report characterizes a few investor groups and what advantages and disadvantages they might have vis-a-vis conservation investments to provide initial guidance. But there is obviously much more granularity to this, it requires quite a lot of work to actually get to know these groups sufficiently well to know who should be approached with a certain investment opportunity. I think another important aspect, and that's maybe one of the challenges of conservation finance, which I hope you can see here on the slide, are the different cost levels for delivering these investments, which are threefold. I mean, one on the very left is obviously delivering the actual conservation activity. So what typically a conservation organization would use a large portion of its funding to implement on the ground these conservation activities. But then in addition, for an investment, there are of course costs attached to the actual investment vehicle, and those vary quite widely by type of investment vehicle that's chosen. So there might be some structures which are quite light and cheap to set up. Others, such as, for example, some investment funds in well-respected jurisdictions, they require a number of service providers to manage that investment vehicle and to do the risk management and take custody of investors' accounts, etc., which tends to be quite a significant cost. And that's of course something that needs to be factored in. So the investment opportunity must not only provide a return in itself that's attractive enough for investors, but also must be able to carry basically that overhead cost of the investment vehicle itself, which is an important factor to consider. And then depending on the type of vehicle, I mean, if it's not a a single project that's being financed, but say if there's, for example, an investment fund that's being set up to invest in a certain area or region, there is also cost attached to the investment activities. So to identifying investment opportunities, to analyzing them, monitoring them, etc., etc. So that's a third level of costs which should be considered. And that's more to see, okay, if you are working on an actual conservation investment, to make sure that in your financial model that analyzes the viability and attractiveness of that opportunity, to make sure that all these layers are, properly accounted for, to make sure that the return expectations that is communicated to potential investors is also accurate. And then the report highlights a number of case studies. I'd like to just go into one or two of them to give a rough idea. We try to get a sample of different legal structures and approaches that are taken to channel money to conservation goals. One is an investment fund structure that I'm sure many of you are familiar, Eco Enterprises Fund, which operates in Latin America, which is really quite a classical investment fund structure. So on the right side, you see there are investors. They put their money into a vehicle, which is the fund itself, and the fund then makes equity or debt investments in portfolio companies. So it's pretty straightforward. The only special thing, quote unquote, in this case is that the strategy is to finance companies that have a positive impact on the environment they're operating in. So these are often companies that trade sustainably produced forest products and the like, and the fund manager is obviously specialized in that and works in this case with independent experts to verify the conservation metrics that the portfolio companies are supposed to achieve. So there is an element of checks and balances in this structure to make sure that what is being reported by the fund in terms of non-financial impacts is also independently verified and not just reported by the fund manager itself. Another example is one of the vehicle actually being a company, Ibis Rice, where basically the concept is to teach rice farmers in Cambodia practices that are environmentally friendly, and the name comes from the ibis bird, so that should protect also the giant ibis which lives in those areas. And the rice really here that is being certified is ultimately sold, so there is a physical product out of which money is being gained, and that helps to basically back the structure of NGOs that are promoting this project. So there is a cash flow that comes directly out of a physical good, so to speak. Another example is one where WWF is actually involved in. That's a stock selection fund together with Erste Asset Management in Austria. So this is a vehicle where basically the investment criteria, so the criteria to select investments have been defined in a way to make sure that those are actually companies that have a positive impact on the environment. So it's more of a filtering kind of approach, which is being taken here. And the interesting thing here is that this is really a project or a product that invests in listed equities. So it's really connecting this conservation finance space to the mainstream capital markets, where shares are being listed and traded on the stock exchange, but where only a subset of the available shares is being considered for this product, to make sure that the companies which are in the portfolio are in fact contributing to the environment in a positive way. Final example that I quickly wanted to highlight, and there obviously are more details and a brief description of each of these cases in the report, is the IFC Forests Bond, which works with carbon credits. So here the IFC has arranged a bond which is basically a structure that takes on capital from investors, invests it in a project, in this case in Kenya, where carbon credits are being produced, and the investors then have the choice to be repaid either in US dollars, in cash, or via these carbon credits. And then obviously, depending on the development of the price of carbon credits, they might choose to choose either option. And there is a buyer of last resort, so to speak, who buys the carbon credit at an agreed floor price in case the investors don't want to buy those carbon credits themselves. That is BHP Billiton, that is offsetting basically the emissions of their business. And in this case, the mission working with them and advising them was Conservation International. So I think that's what I wanted to highlight in this presentation, to give a brief overview of some of the components of the report. Now, Desha has already collected a few questions from listeners that I'm happy to address. But we can also take on additional questions that might have come up now or been submitted in the meantime. So, Desha, how would you like to go about it?
Brilliant. Thank you so much, Kaspar, for that introduction. And we have actually some of the question people on the call. So Khalid and Joanne, you sent some questions in, and it might be good to start with yours first. And these are the ones that, Kaspar, we sent on, followed by Thomas and Anton. But maybe if others have some questions as well, please raise your hands or maybe add them in the chat feed while we start with one. So maybe Khalid, would you like to start?
Yeah, hi. This is Khalid from Tigers Alive team. So, hi. We have an initiative which is now being rolled out into 9 countries called Conservation Assured Tiger Standards. And we have been working on protected areas and sites. One of the gaps which we have found, and the challenge is to get a sustainable funding for these protected areas. So in the past, I have come across various other mechanisms like conservation bonds and other things. So I was trying, and could you advise what could be the other ways and mechanism beyond green bonds, which we could be looking for protected area financing? There is already some protected area financing mechanism like Bhutan for Life. But beyond these two, is there anything else which is emerging on the conservation canvas which we can also look for?
Sure. Well, thanks a lot for that, Khalid. Sounds like some really exciting work you're doing there. I think I mean, bonds in general, I guess, have some advantages and disadvantages, and there might be other structures that are more suited to the kind of work that you're doing. I think, it's hard for me to. I mean, I can speak about the trends that we are seeing, to provide concrete advice for the project you're working on. Would require me to look at it in more detail, I think. But going through the steps that we discussed, will probably help you to see what might be suitable structures. So to see, which are the stakeholders that operate in the areas you're trying to protect, and how are they impacted by those protection measures in terms of, them maybe losing revenue that they would otherwise have had. I imagine, there might be a tiger habitat that's a forest, so that it could be logged, and there might be, people that would benefit from that logging that wouldn't do so if it's protected. And then to go to the next step and see, okay, what are the revenues or cost reductions that can be gained if that habitat is actually protected? Are there maybe ecosystem services that could be valued? Is there a way to, manage the natural resources in that area sustainably, so to have cash flows out of that, but not in a way that damages the habitat, and to go through those steps and then to see, okay, what are the financing requirements that you have, what is the term and volume that you need, and then see what could be suitable. I think on a higher level, to answer your question more theoretically without consideration for what you actually need in your specific case, I think what is gaining a lot of attention recently is our blended finance structures. So I think especially for cases where the return potential is maybe not that clear or not that established yet, or there is limited track record, those structures can help to attract capital from private investors. So blended finance would be structures where you have some public money or foundation money that takes higher risk than the money from private investors, or maybe even provides a guarantee in the case of a loan to help reduce the downside risk of the project that you are financing. And then often what also is used are impact bond like structures or payment for success like structures, where a project implementer would basically say, I believe that by implementing my program, I can achieve certain non-financial outcomes, be that number of in your case, potentially tigers that live in a certain habitat or other kind of metrics, and then to match that with foundations or government bodies that follow the same goals, and basically to get them to fund you upon successful implementation of those measures, which can sometimes make it easier to obtain capital, because it does not have to be invested upfront by the organization that's actually interested in the outcome. So you might get an impact investor to fund you for the implementation of that project, which, when successful, will then be refunded by a foundation or a government that is interested in the outcome. We're seeing we're seeing some of these structures also implemented in the land use space, for example, in the US, in Iowa, where a similar structure is being used in an agricultural area that has trouble with a lot of runoff from the agricultural fields. So basically, their investors finance the implementation of better practices in those farm areas, and the affected municipalities will repay them if basically contamination levels can be reduced by a certain percentage within a given time frame. So it's basically a way to not have the municipality pay upfront for the project in whose outcome it's interested. So that might be an interesting structure to think about. Then what a third route might be is to work with corporates that source from the region that you're active in. They obviously have both, I mean, kind of a pure business interest to secure their sourcing areas and to secure their license to operate in their sourcing areas. So this is something you might be able to leverage. So certainly also a route that I would consider taking. And Paul is also working with a number of leading corporates in that space. So you might also, if you want to add some of your experience to that might also be interesting, Paul.
Quickly, just one thing, just to know your basically idea and with your experience, is the blockchain which is emerging, the green list is using it. What do you see that as one of the instruments in the conservation finance sector? Is it worthwhile exploring?
Well, I think yes and no. I mean, there's obviously
I don't know, because there are people getting engaged onto it, and I've seen recently the whole green chain by IUCN and building up the whole project onto that. That's the sole reason why I'm asking.
I think it's something to keep an eye on. I think the technology that underlies it, so this distributed ledger technology can be interesting in various ways when it comes to conservation finance. I think, one might be to actually, tokenize impacts that you're achieving. And another way might be to just help you fundraise through, a mechanism which is maybe cheaper than the financial market. At the same time, I guess the quality of the project that you're working on, will determine, if it's actually interesting for investors. I think the structure that you're packaging it in is kind of secondary. So, a technology like blockchain might be a fancy and sexy way to package it. If it is really the most efficient, I guess that has to be seen in a case by case basis.
Thanks for your feedback. Yeah.
Great, thanks Khalid for that. I'm conscious as we're starting to get quite a few questions now on the chat feed, so I'd like to maybe move on to first Richard's question and then maybe Ludovic's. Richard, you mentioned whether there's any concrete examples of investments that have generated a return for investors. Would you have a specific example, Kaspar, that you might be able to share?
Well, I think the challenge is obviously that many of the investments in the conservation finance space are private investments, which means there is no reporting on them that needs to be done, and consequently also not a lot of reporting that is being done. I think it also depends a bit on what you subsume in the sector. But for example, among the case studies in the report, the IFC Forest Bond is an instrument which yields a financial return to investors, which is basically backed by IFC's credit rating. So that would be an example of an investment structure which has a positive financial return. But when it comes to a lot of the investment funds or private transactions that maybe foundations or family offices are making in the space, there is not a lot of transparency around what the actual returns are. So I think this is also something that if any of you is actually working on such structures, I think it's something to consider. If it's possible to structure it in a way that this experience is also shared. There often are kind of status reports and reports on the impact of those investments, but rarely is it possible to actually see what the financials look like. So I think having more transparency around that would probably benefit the sector, and also make it easier for investors to become comfortable with these type of investments.
Brilliant. Thank you, Kaspar. Ludwig, I'll let you ask your question.
Hello.
Hello.
Yeah, thank you very much for this presentation that gave us a clear overview of what is possible for mobilizing financial research for conservation investment. Yeah, I know that this type of investment very interesting for the investment fund. But this investment funds are sometimes this strong requirement in terms of project development. So, do you have any plan to support project owner to develop eligible conservation projects that can to be funded? Over. And I have a second question. It's about the key element to attract the classic companies that are investing more in the economic project to invest in the conservation project, even the return, economic or financial benefit are not guaranteed. Over.
Mm-hmm. Well, thanks a lot for those questions. I think when it comes to project development and financing that, I think it's an important component of these kind of, preparing these kind of investments. It's not something that we would fund, but there are several groups that would support project development. I think it's something where there used to be a scarcity of investment funds to actually fund such projects. Now that conservation finance has gained a lot of attention, I think there is more investor appetite than there are actually investable projects. So some conservation organizations, for example, Conservation International, are considering to put more money towards project development rather than investing in the actual projects once they are developed. So I think that's certainly something which is an important factor. Not something we would do ourselves, but we would see that that could actually be one of the roles of conservation organizations to lay that groundwork. I mean, in the report we highlight the number of roles that groups like WWF could play to make it easier for investors to consider conservation finance, and obviously a lot of it has to do with applying the expertise that has been gained on the ground and in those landscapes to write the right policies, investment strategies, to maybe be part of the governance structures of investment funds that have a conservation angle, or to maybe be an independent verifier of the outcomes that are being achieved. I think one very important role that could be played by conservation organizations is indeed to fund the project development. And then with regards to the low returns, I think this is certainly a challenge. I mean, there's a lot of excitement around conservation finance, but at least my subjective take would be that when it comes to signing the transactions, few groups are actually willing to take lower returns, accept low returns. I think there is a role for these blended finance structures to de-risk those transactions. Obviously, if the risk is reduced, the return requirement is also lower. So those are ways to make those investment opportunities more attractive in the eyes of more commercially minded investors. And I think what we're seeing in many cases is that there are foundations or conservation organizations or maybe family offices that care about conservation, that are basically pushing these transaction structures and showing what the returns are that can be achieved. And then more commercially minded investors would only come at the second stage to invest into already proven investment concepts. So I think there is no good way around having either a track record that shows what returns you will be able to achieve, or having a structure which is sufficiently de-risked to basically convince investors that it's not entirely clear what returns can be achieved, or maybe the model is new, is untested, but at least the downside risk that is being taken is kind of mitigated by be it kind of a junior tranche in an investment fund, or a credit guarantee, or some other form of de-risking that is possible.
Thank you, Kaspar. Thank you.
You're welcome.
Thank you for that. So I'll just open up for further questions. Just one last one. I think, Margaret, you've just raised your hand. Jeffrey, I've noticed that Trevor's responded to one of your questions in the chat feed. So I might let Margaret ask her question first, if that's okay.
Sure, but anyway, I would like to have a conversation on that. That's fine. Mark can proceed. I don't know if I want to.
Thank you, Disha, and thank you, Jeffrey. Thanks a lot to the Landscape Finance Lab for bringing this together, bringing the report together. Thank you, Kaspar, for your presentation. I really appreciate it. I just wanted to make sure for those of you who may not be in the finance practice but are interested in this area, there is an area of collective action and innovation organized underneath the within the finance practice, where, for example, the Landscape Finance Lab work lives, where our conservation finance work lives, where some of the fund-related work lives. That's something we call the green financial solutions. Elizabeth Aceituno, who's on the call here with us, is in our finance practice core team and works with the leaders of that area of collective action and innovation. So for any of you who are more interested in what kinds of things we're thinking about taking on in WWF with relationship to this a bit more broadly, please do reach out. This is great. Kaspar, thank you very much.
Thanks, Margaret. Jeffrey, we have a few minutes for you if you want to go ahead.
Thanks very much. So I think the first question is has pretty much been answered by Margaret, and I think the document that has been shared by Trev. So that's fantastic. So just a second question, just a little bit of reflection. I know I've had this conversation with Paul a number of times, particularly on how can we engage local banks, not particularly to make sure that the investment is green, but including them in accessing and leveraging international financing. Because across Eastern Africa, there have been some discussions around how banks could also be involved in climate change financing, particularly reducing risk for either agriculture or forest-related issues. The capacity of these local banks has been challenging, but also because this is quite a new area for them, climate change or conservation, environment in general. So just from your experience, if you came across any experience across the globe where you could be useful to our work on the ground. Over.
Sure. I mean, when it comes to engaging banks, I think this is one of the cases where it's important to understand, how those institutions work and what might be the best entry point into those. So I think it's one cases where it's really important to do your homework, so to speak, and make sure that you approach them with the right pitch and approach the right team and maybe the right country operations to increase chances of a successful collaboration. I think one case that's also covered in the report that might be interesting to look at is Finance in Motion, which is a fund based in Germany that's investing into conservation finance through banks. So they work with financial institutions. So I think they will probably be able to share, some of their experience. I think what we in our work have found quite challenging, especially in the current interest rate environment, is that basically the pitch, so to speak, would be to say to banks, okay, you have access to capital at a certain cost and you're doing your mainstream business with that capital, and we have access to lower cost capital, but that's conditional on being used for a certain type of project that maybe has a positive impact on conservation. And in the current interest rate environments, that's not really a story you can play, because refinancing rates are already very low. So the financial incentive to actually access, say, green credit lines that are maybe slightly cheaper is very low, because that financial difference is very limited. I think, again, this is an area where maybe it's more promising to work through de-risking mechanisms. So if there is a way that you can bring in a guarantee component, that could make it much more interesting for those banks to actually lend to green projects, by saying, you do that with maybe even your existing financial resources, but if you finance projects that follow certain green or conservation related criteria, there is maybe a guarantee mechanism in place that can protect your losses in case the borrower does not repay.
Brilliant. So we have time for one final question before the end of the call, if anybody wants to jump on.
Just one from me, Kaspar. What do you see as the big initiatives that are coming up that start to answer these questions? Are you seeing any really exciting prospects or programs that are being built at the moment that we should pay attention to?
Well, I think there are a number of initiatives that are starting, which it's maybe too early to say what they will do, but that are quite promising. I think among the existing groups that have been very active, I think IFC is still very interested to support carbon-related projects. So I think if there are good projects, they would certainly be a group that promotes them, also in continuation of the forest bonds that have been out there. There are a number of asset managers which are raising funds. So there's, for example, And Green, that's looking to invest into the agriculture space. There is the Land Degradation Neutrality Fund, which is, I understand, about to start. And there are also some US-based groups that are, for example, backed by family offices or others that are starting to engage in the fishery space. So there's really a lot that's happening. Clarmondial itself is also raising a fund which is looking at sustainable agriculture in emerging markets. It's a credit product that will provide working capital, something we're working at on the moment at the moment, and we see there is quite a lot of demand for that out there, both on the financing side as well as among investors. And then there are obviously things that you are working on in the Landscape Finance Lab, which I think is a platform that can engage corporates and other stakeholders in those regions to really achieve also transactions that are multifaceted and look at the landscape as a whole, and consequently also have the potential to really mobilize significant funding pools.
Kaspar, it's Catherine on the line from the Blended Finance Task Force as well. I thought I would just jump in to say that there are also a number of these almost a level up initiatives which are looking to support those almost examples of funds and vehicles which can mobilize private capital for the SDGs, particularly for sustainable land use, oceans plastic, sustainable fisheries. And so the Blended Finance Task Force work which Landscape Lab and even the work of the Climate Policy Initiative and these kind of incubators and platforms as well. There's a really strong momentum which we are seeing even within the development banks as well, about how do we get large scale conservative mainstream capital from institutional investors into SDG related projects and into emerging markets. And so it's a really heartening space at the moment where we're seeing investor-driven initiatives like the Blended Finance Task Force, for example, saying we see not only that there's a huge impact to investing in sustainable land use or clean energy, whatever it is, but that there's also it makes business sense. Infrastructure in Africa is not as risky as we thought. There are blended finance instruments which can reduce or address some of those risks. And actually, it's a way to diversify, it's a way to increase returns, and it's a way to address some of our kind of climate exposure risks as well. So we're just seeing a really nice momentum in the investing community as well.
Yeah. Thanks for that, Catherine. I think that's completely right. It's very interesting that there is also a put from investors actually for more product in this space. So I think it's an interesting moment in time where there has been some track record of conservation finance, structures that have been tested, some of which we document in the report, which is matched by appetite from actually, investors or their clients to look at those projects. But at least what we still see as a kind of a bottleneck is really projects that that are sufficiently developed and structured in a way that they actually become relevant for those investors. But there are a number of groups working on these. So I think chances are that over the next couple of years, we'll actually see more of those structures come to fruition and being financed.
Couldn't agree more. It's a good year, I think, for this, Kaspar, and thanks so much for such a great presentation as well.
Welcome.
And that's probably a good place to end. So thank you so much, Kaspar, for your presentation, and all of you for joining the webinar today. We'll share a summary on the Landscape Finance Lab platform, where you're welcome to leave further questions. Kaspar is on the lab community, so we can also tag you, Kaspar, so that you can maybe respond there as well if there is a further debate or discussion that goes on following the call.
Sure, great. Well, thanks.
Brilliant.
Thank you, Paul, for organizing this. It's been a pleasure.
Perfect.
Thank you, Kaspar.
Thank you. Bye bye.
Okay.
Bye-bye.
Thank you. Thank you, Kaspar. Thank you, Disha.
Thanks.